Tyler buys a duplex. Logan drops the exact same money into a Vanguard index fund. They both walk away absolutely convinced the other guy made the dumber move. They're both wrong. And the reason isn't real estate. It isn't stocks. It's a single number neither one of them ever bothered to actually pull out of the calculator. By year 20, that number turns this whole comparison into something neither of them saw coming. Let's set this up clean. Tyler and Logan are both 28. Same city, same job market, same starting paycheck. They each have $60,000 sitting in savings. They each earn $62,000 a year. The only thing separating them from here is what they decide to do with that pile of cash. Tyler uses his $60,000 as a 20% down payment on a $300,000 duplex. Decent neighborhood, 2 bedrooms up, 1 bedroom unit below, built in the 1980s, solid bones. Nothing fancy. He locks in a 30-year mortgage at 6.8%. His monthly payment with principal, interest, and escrow lands at about $1,565. He finds tenants for both units almost immediately. Combined rent, $2,150 a month. That's $585 a month in pure profit. Sitting right there on the spreadsheet before he spends a single dollar on anything else. Tyler feels like he just cracked the code. Logan takes that same $60,000 and parks it inside a total market index fund. No leverage, no tenants, no keys to hand over to anyone. He sets up an automatic contribution, $400 a month. Then he basically forgets it exists. His coworkers ask him what he's been investing in. He says, index funds. They smile, nod, and change the subject. Nobody is impressed. Nobody asks a follow-up question on day one. Tyler has a duplex, 2 tenants, and a story to tell at every family barbecue for the next decade. Logan has a brokerage account and a 1-line confirmation email. It's not even close in terms of how it feels. But the headline number and the keep number are not the same animal. You'll see what I mean. For the first stretch of being a landlord, Tyler is living the dream he saw on YouTube. Rent shows up on the 1st of every month. He drives past the duplex on his way to work and feels something his stock, investing friends, can't replicate. He owns that. He's writing off mortgage interest. He's deducting depreciation against his W-2 income. That alone saves him about $2,500 on his tax bill the first year. He's watching listings in the same zip code creep upward month after month. Everything about this feels solid, real, smart. Logan, on the other hand, logs in once a quarter and stares at a number. The number goes up a little, then sideways, then up a little more. Year 1, his $60,000 sits at around $66,000. Year 2, maybe $73,000. There's no key, no tenant, no address he can point at. There's a line on a screen. Tyler's friends ask about the property constantly. Nobody asks Logan about anything. Socially, Tyler is winning by a country mile. Now let's actually run the math through year 3. Tyler has collected roughly $77,400 in combined rent. His mortgage payments total around $56,340. Gross cash flow. The napkin number sits at about $21,060. Looks juicy until you start subtracting all the parts nobody puts on the YouTube thumbnail. Property taxes, $3,600 a year. Insurance, another $1,800. He's already replaced a water heater for $1,500. Patched a roof leak after a brutal winter storm for $2,400. And he ate 1 full month of vacancy when a tenant ghosted him. That cost him $2,150 in lost rent plus $750 to clean and relist. Property management. Tyler does it himself to save the 8% fee, which sounds smart until you count the Saturday showings, the late night plumbing texts, the lunch break repair calls, after every real expense. Tyler's actual net cash from the duplex over 3 years sits between break even and roughly $3,000. Not the $21,000 that looked so juicy on his spreadsheet. And that ignores every single hour of his life he handed over to that building. Logan, meanwhile, has put in $60,000 plus $14,400 in monthly drips. At roughly 10% average annual return, his portfolio sits around $91,000. He spent 0 hours, 0 phone calls, 0 emergencies, but Tyler still has leverage doing heavy lifting in the background. His duplex has appreciated maybe 3 to 4% a year. It's now worth somewhere between $325,000 and $335,000. His equity, the gap between what the property's worth and what he still owes, has grown to roughly $72,000. That's real wealth, and a big chunk of it came from using the bank's money. That's leverage. It's the one trick stock investors cannot easily copy. The rent check is the number everyone shouts about. It's the number on the YouTube thumbnail, the number your landlord cousin loves quoting at the cookout, the number that gets you nodding along while someone explains why their duplex is going to fund retirement. Here's the catch. Look at everything that walks out of that rent check before it actually lands in your bank account. Vacancy. The average single-family rental sits empty about 1 month a year. That's not a disaster, but it's a full mortgage payment with zero income covering it. And when a tenant rolls out, you're paying for cleaning, minor repairs, listing fees, screening services, and your own time chasing tour requests, maintenance and repairs. The rule of thumb is to budget 1 to 2% of the property's value every single year just for upkeep. On a $300,000 duplex, that's $3,000 to $6,000 annually. Some years it's a $200 faucet fix. Other years it's a $7,200 vac replacement in the middle of a July heat wave. When your tenant is 1 degree away from breaking the lease and texting you in all caps, capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These are not surprises. These are guaranteed future costs. They show up in chunks of $5,000 to $15,000. If you're not stashing money for them every single month, you're not running a business. You're running on luck. Property management. If Tyler hires a manager, 8 to 10% of monthly rent vanishes the second it lands. On a $2,150 rent roll, that's about $170 to $215 a month. Gone. If he manages it himself, he's working a part-time job he never signed up for. There's no version of this where management actually costs zero. And then there's the risk nobody loves to put on Instagram. A bad tenant. A renter who stops paying and knows exactly how slow the eviction process is can cost you 3 to 6 months of lost rent plus legal fees. One bad pick can wipe out a full year's profit and then some. None of this shows up in the $585 monthly cash flow number Tyler bragged about at the family barbecue. But it shows up eventually. It always shows up eventually. By year 5, Tyler is living the full landlord experience. He's on his 3rd tenant in the upper unit. He replaced the roof for $9,200. Dealt with a busted main line that cost $1,800 and a Saturday off work. Sat through 5 weeks of total vacancy across both units. He's raised rent to $2,325. Which helps, but property taxes ticked up, insurance ticked up, his actual cash-on-cash return, the money he pockets relative to what he put in, is hovering between 3 and 5% after every real expense. Not bad. Definitely not the 15 to 20% fantasy number he quoted to his brother-in-law at Thanksgiving. Logan, meanwhile, is doing absolutely nothing. Genuinely nothing. His portfolio has crawled from $60,000 to roughly $145,000 to $160,000 by year 7. Contributions included. He didn't pick a single stock. He didn't time a single dip. He didn't refresh his app during the drawdowns. He just didn't touch it. Here's where compounding stops being boring. The gains on his earlier gains are now generating more new wealth each year than his own contributions are. That's the moment the curve flips on you. Tyler's wealth is growing too, slowly, steadily, with constant attention. Logan's wealth is growing in a curve, boring for the first 5 years, astonishing for the next 15. Let's jump to year 10. Tyler's duplex is worth roughly $400,000 to $420,000. His remaining mortgage balance sits near $200,000. That puts his equity around $200,000 to $220,000 after 10 years of real expenses. Mortgage interest, taxes, insurance, repairs, vacancies, capital expenditures. Tyler's total out-of-pocket beyond his original $60,000 down payment is somewhere between $25,000 and $40,000. Logan's portfolio, with steady $400 monthly contributions and roughly 10% average annual returns, sits around $220,000. He's put in $60,000 up front plus $48,000 in monthly drips. $108,000 total. The rest is pure compounded growth, and he spent exactly 0 weekends fixing anything. At the 10-year mark, they're suddenly in the same neighborhood. Tyler might be a hair ahead because of leverage, but Tyler also dropped hundreds of hours into managing that property, took on hundreds of thousands of dollars in debt, and concentrated every penny in one building, in one zip code, with one local economy holding the whole bet up. Logan diversified across thousands of companies and never missed sleep over any of it. Fast forward to year 20. Tyler's duplex is worth roughly $540,000 to $600,000. The mortgage is down to a small fraction of where it started. Equity sits between $460,000 and $580,000, depending on appreciation. He's been collecting rent the whole stretch, but after 20 years of upkeep, turnover, capital expenditures, taxes, insurance, and at least one major renovation, his total net profit from cash flow alone is maybe $50,000 to $95,000 above what he spent. More in a strong market, less in a flat one. Logan's portfolio, at 10% average annual returns with $400 a month. His original $60,000 has grown to roughly $520,000 to $560,000. Total contributions over 20 years, $156,000. The other $360,000 or more is pure compounding, no debt, no tenants. No 2M phone calls about a frozen pipe in February. When you stack net worth side by side, they're in the same ballpark, somewhere between $500,000 and $600,000 each. But how they got there? Two completely different lives. Tyler worked for his. Logan waited for his. Tyler carried stress, risk concentration, and illiquidity. Logan carried volatility, but liquidity and freedom. And here's the part that quietly changes the entire math. If Logan had bumped his monthly contribution to $600 instead of $400, his 20-year portfolio jumps to roughly $640,000 to $680,000. Because in the stock market, raising your contribution gets multiplied by compounding. In real estate, raising your investment usually means buying another building, another mortgage, another set of toilets to worry about. If I only showed you the downsides of real estate, I'd be doing exactly what every index fund influencer does on TikTok. Stocks have real risks too, the kind that get glossed over in the 30-second clips. Volatility is brutal. In 2008, the market dropped roughly 37%. In March 2020, it fell 34% in a single month. In 2022, the index slid almost 25% before clawing back. If Logan had $150,000 and watched it crater to $95,000 in a few weeks, that's not a line on a screen. That's the kind of gut punch that wakes you up at 3 a.m. wondering if you should pull everything out. And the research is brutally clear. Most retail investors panic sell during crashes and then buy back after the recovery, locking in losses at the worst possible moment every single cycle. There's no monthly cash flow either. Index funds don't mail you a check. Dividends exist, sure, on a total market fund. You're looking at maybe 1.5 to 2% yield on $150,000. That's about $200 a month. That's not replacing anyone's salary, no leverage. Logan used $60,000 to control $60,000 in assets. Tyler used $60,000 to control $300,000 in assets. That 5-to-1 leverage is a real advantage when property values rise. It's the reason real estate has minted more millionaires than the stock market in plenty of surveys. And there's no tax magic on the index side. Real estate investors get to deduct depreciation, a theoretical decline in their building's value, against their taxable income, even when the building is actually going up in price. That's a legal tax shelter index investors simply don't have access to outside of retirement accounts. Real estate wins in specific identifiable setups. If you're buying in a market where monthly rent hits at least 0.8 to 1% of the purchase price, the cash flow math works from day one. If you treat the property like a business instead of a side hustle, with proper tenant screening, real reserves, real systems, the returns can absolutely beat stocks, especially with leverage doing the lifting. If you house hack living in one unit while renting the others, you can crush your personal housing costs down to near zero while still building equity. The stock market simply cannot do that. And if you understand the 1031 exchange, which lets you defer capital gains taxes by rolling profits into a new property, you can grow real estate wealth tax deferred in a way stock investors can't replicate outside an IRA. Real estate isn't a bad investment. It's a misread one. Tyler and Logan both walked away from that single decision absolutely convinced they had picked the smart play. Tyler believed real estate was the proven path. Logan believed the market would do the work for him. Neither one of them actually sat down and ran the full receipt. Not the gross number, the keep number. In dollars, in hours, in stress, and in risk stretched over 10 or 20 years. The real trap isn't real estate. It isn't the stock market either. The real trap is picking either one based on a podcast clip, a viral thumbnail, or a confident take from your uncle at Thanksgiving without ever doing the math on your own situation. And if you're sitting there wondering what happens when you do both, when you stack a rental property and an index fund at the same time and let leverage and compounding run together, that's a completely different conversation, and the math gets wild. But for now, the next time someone tells you real estate always wins, or the market always wins, ask them one thing. What does the keep number say? Because the gross number sells the dream. The keep number tells the truth, and the truth is the only thing your future is actually built on.